Ever wondered about the different types of mortgages available when you're considering buying a house? Well, you're not alone. Mortgages are fundamental to the home buying process, but the variety can be overwhelming. Understanding the different types of mortgages can ease the process and help you make the right decision to suit your financial situation. In this video, we'll be exploring various mortgage types, ranging from the conventional fixed-rate mortgage and adjustable-rate mortgage to government-insured loans like the FHA, Virginia, and USDA loans. We'll also delve into the specifics of the interest-only mortgage, balloon mortgage, jumbo loan, interest-adjustable rate mortgage, and combo or piggyback loans. Each of these mortgage types has its unique features, pros and cons, which we'll examine in detail. By the end of this video, you'll have a clearer understanding of the mortgage landscape. So let's dive into the fascinating world of mortgages. First up, we have the conventional fixed-rate mortgage, a classic choice for many home buyers. This is the most traditional type of mortgage where you borrow a set amount of money at a fixed interest rate. It's like having a predictable monthly subscription, but for your house, you make consistent monthly payments over the life of the loan, which typically spans 15, 20, or 30 years. The beauty of this mortgage type lies in its predictability. Your monthly payments remain the same, providing stability and making long-term budgeting a breeze. However, it's not all roses. This type of mortgage may require a higher credit score. If your credit is less than perfect, you might face potentially higher interest rates. So if you're someone who prefers stability over unpredictability and you have a good credit score, the conventional fixed-rate mortgage could be your go-to. Remember, FHRM offers stability but requires a good credit score. Next, let's discuss the adjustable rate mortgage, which offers a bit more flexibility. This type of mortgage is quite intriguing. It offers a lower initial interest rate for a specific period, usually 5, 7, or 10 years. After this period, the rate can adjust periodically based on market conditions. This could be a boon if you're planning to move before the initial period ends, as you could benefit from those lower initial rates. However, there's a flip side. The interest rate uncertainty after the fixed period can lead to potentially higher payments in the future. This variability can make budgeting a challenge. So while the adjustable rate mortgage can offer initial savings, the key word here is initial. If you're considering an ARM, it's crucial to understand how much and how often your mortgage payment could change. Keep in mind, ARM offers initial savings, but can be unpredictable. Moving on, we have 3 government-backed options: FHA, Virginia, and USDA loans. Let's start with the FHA loan, which stands for Federal Housing Administration. This loan is insured by the government and is often a go-to for those who may not have a hefty down payment saved up. With an FHA loan, you can put down as little as 3.5%. It's also known for more flexible credit requirements, making it accessible for borrowers with lower credit scores. However, this loan requires mortgage insurance, slightly increasing your monthly costs. Next up, we have the VA loan, short for the U.S. Department of Veterans Affairs. This loan is a fantastic option for eligible veterans, active duty service members, and certain members of the National Guard and Reserves. The VA loan stands out because it doesn't require a down payment. Plus, it offers competitive interest rates. The cherry on top? There's no need for private mortgage insurance. However, its eligibility is limited to veterans and their families. Lastly, we have the USDA loan, backed by the U.S. Department of Agriculture. This loan is designed for eligible rural and suburban homebuyers. It offers low or even no down payment options, making homeownership more attainable for those living in qualifying areas. The USDA loan also boasts competitive interest rates. However, keep in mind that it's limited to rural and suburban areas, and income limits may apply. In summary, these 3 loan types, FHA, Virginia, and USDA, offer unique benefits that can help certain borrowers overcome some of the common barriers to homeownership. FHA loans are great for those with smaller down payments or lower credit scores. VA loans are a fantastic option for our veterans and their families, offering 0 down payment and no private mortgage insurance. USDA loans, on the other hand, can make homeownership a reality for those in rural and suburban areas. However, it's essential to remember that these loans do come with certain restrictions and requirements. So it's crucial to do your homework before deciding which loan is the best fit for you. These loans offer easier access to homeownership but come with certain restrictions. Scene script, let's now explore two unique mortgage types, the interest-only mortgage and the balloon mortgage. First up, we have the interest-only mortgage. This type of mortgage allows you to pay only the interest for a specified initial period, typically between 5 to 10 years. After this period, you start paying both the principal and the interest. This might sound like a sweet deal at first, right? Lower initial payments during the interest-only period can be attractive, especially if your income is expected to increase in the future. However, it's important to keep in mind that this initial relief comes with a catch, a balloon payment after the interest-only period, which can significantly increase your monthly payments. Therefore, it's crucial to plan ahead to ensure you can afford these higher payments later on. Next, let's delve into the balloon mortgage. This mortgage offers lower monthly payments for a fixed period, usually between 5 to 7 years. But here's the twist. Once the fixed period is over, you're required to make a large balloon payment to pay off the remaining balance. The pros of this mortgage type are similar to the interest-only mortgage, lower initial payments during the fixed period. However, the cons can be quite significant. The large lump sum payment at the end can be daunting, and if you're not prepared, it could lead to financial strain. There's also the risk of having to refinance or sell your property to cover the balloon payment. So, as you can see, both the interest-only and balloon mortgages offer lower initial payments, which can be a relief for many homeowners. However, the potential for higher payments later on requires careful consideration and planning. Remember, these options can offer initial relief but might lead to higher payments later. So, before you decide on the type of mortgage that suits you best, it's important to weigh the pros and cons, and most importantly, understand your financial capacity to meet the future payments. For those eyeing more expensive homes, the jumbo loan might be your go-to option. Jumbo loans are designed for home purchases that exceed the conventional loan limits set by the Federal Housing Finance Agency. This type of loan is like the giant sequoia of the mortgage forest, allowing you to finance more expensive homes that exceed the limits of other loan types. Now, the pros of a jumbo loan are fairly straightforward. It enables you to finance pricier homes that can't be covered by conventional loans. Imagine landing your dream mansion and not having to compromise because of loan limits. However, these loans are not all sunshine and rainbows. They have stricter eligibility requirements. You'll need a higher credit score and a larger down payment than most other loans. Plus, you might face higher interest rates. So it's a bit of a trade-off. While jumbo loans can finance pricier homes, they come with stricter requirements. It's kind of like being invited to a fancy party, but you have to dress the part. Next in line is the interest-adjustable rate mortgage, a blend of initial savings and flexibility. The interest-adjustable rate mortgage, also known as the IOARM, offers an enticing mix of lower initial payments with a period of adjustable interest and principal payments. This home loan option allows you to enjoy the luxury of only paying the interest for a specified initial period, typically 5 to 10 years. After this period, the loan adjusts and you begin paying both the principal and the interest. This adjustment can result in a potential payment shock, as the monthly mortgage payments can increase significantly. Hence, it's crucial to plan for this eventual increase from the get-go. So, while the IOARM can offer a period of lower payments, providing initial savings and flexibility, it's important to stay mindful of the potential for higher payments down the line. IOARM can offer lower initial payments, but beware of potential payment shocks. Lastly, we have the combo or piggyback loans, a creative way to avoid PMI. This loan type is a 2-for-1 deal. It involves securing a first mortgage and then piggybacking a home equity line of credit, or HELOC, or a second mortgage on top of it. The main goal here is to dodge the private mortgage insurance, or PMI, and potentially lower the initial down payment. Now let's talk about the upsides. The primary benefit lies in avoiding PMI, which can save you a substantial amount of money over time. Additionally, you may be able to make a smaller down payment without increasing your monthly mortgage payment. However, there are downsides. You're dealing with 2 loans instead of 1, which can complicate matters. The risk factor also escalates as you're essentially borrowing more than the value of your home. To sum it up, combo loans can help you avoid PMI, but they can be more complex and risky. Now that you know about the different types of mortgages, how do you choose the right one? It's a question that requires careful thought and consideration. After all, your mortgage will likely be the biggest financial commitment you'll ever make. Start by assessing your financial situation. How stable is your income? What is your debt-to-income ratio? You'll need to be honest with yourself about what you can comfortably afford. If you're looking for predictable payments and long-term budgeting, a fixed-rate mortgage might be your best bet. But if you're confident that your financial situation will improve in the near future, an adjustable-rate mortgage with a lower initial rate could work for you. Next, consider your credit score. If it's high, you'll have more options and potentially lower interest rates. If it's low, government-insured loans like FHA, Virginia, or USDA loans could provide the flexibility you need. Remember, a higher credit score can open the door to more favorable loan terms, so it might be worth improving your credit before applying for a mortgage. Don't forget to think about your long-term plans. How long do you plan to stay in the home? If you expect to move within a few years, an adjustable-rate mortgage or interest-only mortgage might make sense. But if you're planning to stay put for the long haul, a conventional fixed-rate mortgage could provide the stability you need. Lastly, consider the size of the loan you'll need. If you're eyeing a more expensive home that exceeds conventional loan limits, a jumbo loan might be your only option. But remember, this typically requires a higher credit score and larger down payment. Choosing the right mortgage is a big decision, and it's not one to be taken lightly. Consult with a financial advisor or mortgage broker to fully understand your options and make the most informed decision. Remember, the right mortgage for you depends on your unique circumstances. So, there you have it, a comprehensive guide to the different types of mortgages. We've journeyed through a variety of home loans, each with its unique features, pros, and cons. Let's do a quick recap. We started with the conventional fixed-rate mortgage, a traditional choice offering predictable monthly payments, stable interest rates, and long-term budgeting. Then we tackled the adjustable-rate mortgage, a tempting option with lower initial rates, but potential for higher payments down the line. Next, we explored government-insured options like the FHA, Virginia, and USDA loans. These options make home buying more accessible, with benefits like lower down payments and more flexible credit requirements, but they do come with certain limitations and additional costs. We also discussed the interest-only mortgage and the balloon mortgage. These options offer lower initial payments, but beware of the balloon payment or the jump-in payments after the initial period. The jumbo loan, catering to more expensive home purchases, offers the ability to finance beyond conventional loan limits, but it does come with stricter requirements and potentially higher interest rates. The interest-adjustable rate mortgage offers an initial period of interest-only payments, but could lead to payment shock after the initial period. And finally, the combo or piggyback loans allow borrowers to avoid private mortgage insurance and potentially lower the initial down payment, but managing two loans can be complex and risky. In the end, the right mortgage for you depends on your unique circumstances, financial situation, and long-term goals. It's crucial to take the time to understand each option, weigh the pros and cons, and consider your own comfort with risk. Don't hesitate to seek advice from financial advisors or mortgage professionals. Remember, understanding your mortgage options is key to making the best decision for your financial future. Thanks for watching.